world GDP growth was 3% last year, and India, which is $3.2 trillion economy, grew by 7% last year. So India growth was more than double the growth of the global GDP. There was inflationary pressure, there was US banking crisis, but still India came out as an outlier and was a shining star of the last year. But this year, when World Bank is predicting that the world GDP will fall to 1.7% growth as compared to 3.2 last year, so where does India stand? So let's find out what leading brokerage houses and rating agencies are predicting about Indian economy and the stock markets. So in this report by Vedant and Aditya, they are sharing both the aspects.
Hello viewers, we recently had CRISIL and IMF release their economic outlooks on India's GDP, corporate revenue forecast, inflation and a few other parameters. CRISIL's report suggests that India's growth is expected to remain at 6% in the next fiscal year. This is solely driven by increased government spending and rebound in private consumption. Agriculture and services sector are expected to lead this recovery. Corporate revenue forecast is expected to log a double digit again after declining in the last fiscal year. This recovery is driven by sectors such as automobile, consumer goods and steel. These sectors are expected to benefit from government's push for increased demand in infrastructure and overall consumer demands. Manufacturing sector is expected to be the key driver of growth because new companies are expected to invest in new technologies for better productivity and efficiency. Inflation is expected to remain elevated because of post-pandemic issues causing supply chain disruptions. However, the banking sector asset quality is likely to increase as RBI is expected to address NPAs. We also had IMF release its economic outlook on the Indian economy. IMF has maintained a target of 6.1% for India's GDP growth and then ultimately rise to 6.8%. This basically indicates an ultimate acceleration with a temporary dip in the economy. However, post-pandemic issues are still persisting and inflation is still to cause trouble. The rise in crude oil prices might add to these inflationary pressures. In a gist, the report expects India to be a bright spot. And a fact to note is that India along with China are expected to contribute to 50% of global economic growth in this fiscal year.
So as per these reports, the India GDP continues to rise much higher as compared to the other global economies. So let's find about these leading brokerage houses like Goldman Sachs, Morgan Stanley are predicting about Indian stock market. So where the market is headed and what kind of returns one should expect.
So recently Morgan Stanley and Goldman Sachs have released their report on the Indian stock market. Covering Morgan Stanley's report first, they expect Sensex at 68,500 in 2023, which is an upside of around 13 to 15% from the current prices. They believe that Sensex will have an outperformance versus the emerging peers, and they believe that markets are to be led by sectors as domestic consumption, robust banking system, as we can see that NPAs have been falling and the credit and deposit growth have been healthy for the banks. The report also states that sectors which will be contributing are healthcare and consumer discretionary. Digitalization and technology will be accelerated and will play a key role, and we can also see that UPI has been taken globally by the Indian markets. The report states that main focus will be on development, and on the valuations front, the bank thinks that the Nifty and Sensex stand at attractive valuations at a forward PE of 19 and a dividend yield of 1.5%. However, the only risks that they have stated in the reports could be a global slowdown and geopolitical tensions if they escalate between Russia and Ukraine, and also we can see some parts of escalation between China and Taiwan in the recent times. Covering Goldman Sachs, they think that Nifty will reach 20,000 by September 2023, and the investment bank remains overweight on the banking system of India. They believe that strong reforms, improving economic outlook and strong policies from the government and from the central banks could make the markets attractive. We have seen a recent example of this as RBI has decided to put a pause on the interest rate, although they have stated that this is just a pause and not a pivot. The sectors which will be contributing to the up move in the markets are healthcare, industrials and consumer discretionary. Goldman Sachs believes that valuations are at a premium compared to the emerging markets, which is a contrarian view to Morgan Stanley's report, and both the institutions have a positive outlook in the long term for the Indian stock market.
So India remains the biggest bet for the world leading agencies, and as they predict that India can grow much higher as compared to the other economies in the world. So let's hope that India will keep shining and the new achievements will come this year. Thank you very much.